Hi, my name is TJ Camp. I'm Vice President at Poinsett General Insurance Agency, Inc., and I wanted to personally welcome you to this Poinsett General Insurance Agency information presentation. This is part one of a two-part series on the topic, Understanding Market Value versus Replacement Cost Value. More specifically, we're going to discuss how it affects your homeowner's insurance policy. One of the questions we get most often from our insureds is regarding their homeowner's insurance policy, and more specifically, how do we determine how much coverage they actually need? A lot of times we get this exact question. My home is only worth $120,000 according to my realtor. So why does the insurance company want me to insure it for $275,000? This is because a lot of times customers assume that the insurance coverage amount on their homeowner's insurance policy is going to be equal to the amount they actually paid for their new home. 99% of the time, this is not going to be the case unless you have a brand new home that was built within the past several months. So in order to understand why homeowners insurance companies use replacement costs rather than market value, it's important that you actually understand the definition between the two terms. Market value is the amount for which something can be sold on a given market. In regards to homeowners, we're talking about the sales price in a specific neighborhood on a specific house. Replacement cost, however, doesn't take into consideration the external factors that the market may take into consideration, like neighborhood, school district, local businesses, and etc. Replacement cost, however, is the current cost of replacing a fixed asset with a new one of equal effectiveness. What does that mean for you? Let's break it down a little further into simpler terms. Market value is simply the price you paid for a house at a given real estate market price. And replacement cost is the price or cost it will take to rebuild your house in the same spot, at the same size, and the same quality of construction at today's construction costs. So putting it simply, in the event of a total loss on your home, the insurance company is going to pay to build a new home, not buy you one down the street that's similar to the one you have now. That's the difference between replacement costs and market value. Let's look into greater detail at why we don't use market value to determine insurance needs. Let's take a look at the table here on our screen. We have two houses that are identical. The only difference between the two houses is one is in a thriving suburb while the other is in a depressed neighborhood. Both homes have the exact same square footage, were built in the same year. However, because of external factors such as the differences in neighborhoods, the market value of each house is vastly different. The home inside the thriving suburb is worth nearly $285,000. The same identical home is placed inside a depressed neighborhood and it's only worth $120,000. Hypothetically, let's say the house burned to the ground in a total fire loss. The reason the insurance company chooses not to use market value as their coverage amount on an insurance policy boils down to this. It would cost the exact same amount in construction cost to rebuild this house regardless of its location. Looking at the table, it would cost $275,000 in this example to rebuild the house regardless of whether it's in the thriving suburb or in the depressed neighborhood. Therefore, if you go straight on market values, the homeowner's insurance policy in the thriving suburb would have been overinsured by nearly $10,000. Look at the disparity between the market value in the depressed neighborhood and the amount that it would take to replace it. There's a difference of over $155,000. There is absolutely no way that that homeowner would be able to rebuild their home in today's construction costs because they were severely underinsured. So why should you choose replacement costs instead of market value when insuring your house? It's pretty simple. By insuring your home to 100% of the replacement cost, it ensures the ability to rebuild your entire house the way it is currently in the event of a total loss. The sad truth is after a claim occurs, it is not the time to find out your insurance is not adequate. It's simply too late at that point. For more information, please feel free to check out part 2 of this two-part series on market values versus replacement cost value on our YouTube channel, or feel free to jot down information on the following screen and give us a call, or shoot us an email, or send us a Facebook message, and we'll be more than happy to answer your questions. If you live in South Carolina and are interested in a homeowner's insurance policy review to make sure your home is adequately covered, feel free to give us a call at 864-271-4630, or come by our office at 1530 Buncombe Road, Greenville, South Carolina 29609. You can also visit us on the web at www.poinsetgeneral.com and request a homeowner's insurance quote there on our agency website. Also, feel free to submit questions on our agency Facebook page by visiting www.facebook.com/PoinsetGenINS.